Poor Bruce. I think he's joining in. All right. Well, hi, everyone. Thanks again for having us. Okay, so today we're just going to cover over the Ontario PREC rules and how they impact you from a legal and tax perspective. So we've got about an hour here to cover our material and take some questions, so we'll try to get through it and leave enough time for Q&A. I'm Anthony Versillo. I'm an income tax specialist in the Markham office. My practice focuses on owner-managed clients, and I can say that's the case for BDO right across Canada. And I also specialize in income tax planning for our real estate industry team. So today I'll be presenting with a couple of colleagues. And while I'll be going over the income tax matters, we have Michael McIsaac. He's our practice leader for BDO Law, also on the line. He'll cover over go over and cover the legal aspects of Ontario PRECs, as well as Bruce Gowdy, who's an indirect tax specialist, and he's hopefully joining the call soon. He's an indirect tax specialist, meaning he covers everything that's not income tax, so GST, HST, QST, customs duties, etc. And he'll be going over those points. So just a little bit about BDO before we get started here. And for those of you who don't know, we have been around for over 95 years, and we have over 120 offices across Canada and 1,500 offices across the world in over 160 countries. And while we're the 5th largest full service accounting, tax, consulting firm in the world, we do focus on the mid-market, meaning we deal with owner-managed clients and private clients. So in spite of our size, we are in every corner in the country and well positioned to assist with businesses of all sizes and complexities. So don't let the size fool you. We are focused on the mid-market. So with that as a bit of a backdrop, I will pass it over to Michael, who will walk you through the legal.
Thanks, Anthony. Hey, everyone. Looks like we have about 20 participants here on the call. Like Anthony indicated, my name is Michael McIsaac. I'm the managing partner for BDO Law. Much like BDO Law focuses on the small mid-market owner operator entrepreneurial client. We are an extension of BDO. As an affiliate to BDO, our intention here is we're an alternative legal service provider. Okay, so you have traditional law firms, and then more recently, over the past decade or so, you've seen these alternative legal service providers come into play. And what we try to do is offer our clients a holistic and integrated approach to financial, tax, professional, and legal services. Everything is taken together all under one roof. So I want to talk a little bit on a high level today about BDO Law, and then just get into generally sort of the qualifications for setting up these PRECs, and things to think about both from the perspective of a brokerage, but also from the perspective of an agent itself. So Anthony, it looks like you have the control of the slides here. So let's jump to that first one. So here's BDO Law. Excuse me. So like I was saying, we're an alternative legal service provider, and we practice generally in business law, in every area of business law. The best way to think of us is as the extension of BDO Canada. Most of our clients are owner operators, and what we do is we help facilitate either internal corporate reorgs or day-to-day operations, dealing with employment matters, commercial matters, basically, full service law firm. So just jump to the next one there, Anthony. And in terms of the Real Estate Services Act, I don't want to get into the nuances of the legislative readings. Just recognize that this came into force, your ability to create these personal real estate corporations on October 1st of this year. It took probably about a decade to get to this point in time, but I'm happy to say that Ontario has finally met up with the rest of the country. BC, Saskatchewan, Manitoba, Alberta, all these provinces have the ability to personally incorporate for their real estate agents and brokers, and it was a long time coming here in Ontario. In terms of the qualifications for the PRECs themselves, on the next slide, what we'll see is just a real high-level summary of everything that's required here. Okay, so obviously in setting up these corporations, they're going to be OBCA, so Ontario Business Corporations. The most important thing to recognize here is that the registrant, and so that's going to be the sales agent or the broker, they are the only people who are able to be voting shareholders. Okay, so we cannot have anybody other than the registrant own the voting shares in the PREC. You do have the ability to create multiple classes of shares, and this is the benefit for tax deferral opportunities, income splitting opportunities that Anthony and Bruce will talk about later on. But those multiple classes of shares have to be non-voting shares, okay? And those shares can only be held by immediate family members, okay? So the registrant is the voting shareholder. They have to be the officer, the sole officer, and the sole director, okay? The business of that PREC itself is really just to receive compensation, receive the remuneration that the registrant would have otherwise been entitled to receive from the brokerage, okay? The PREC itself cannot practice in the trade of real estate at all. All the trading is going to be done through the brokerage in the brokerage's name, okay? The PREC cannot be a brokerage. No funds can ever be held in the PREC. And the big thing, and this is something that, from a broker's perspective, you really want to think about is there has to be an agreement in place between the agent, the PREC, and the brokerage, okay? And that's going to talk about how the money flows from commissions, remuneration flow from the brokerage through the PREC, and then ultimately get into the hands of the registrant, okay? Right now, traditionally what happens is the agent earns commissions, the commissions are paid from the brokerage to the agent. And we're putting an intermediary in between it, which is the PREC, okay? And so you have to have an agreement in place that talks about the nature of that relationship. From a broker's perspective, it is really, really important that you take a look at what that agreement, what that form of agreement looks like, and that there is proper indemnification and liability language built into it so that the brokerage isn't acquiring any additional liability that it doesn't already have at the moment. Also, so that it's clear when the commissions themselves are going to be paid. Because of this new structure, we can anticipate that people will be incorporating these companies during a period of time in which there are deals in the pipeline, okay? So we incorporate a company yesterday or today, and we close on a transaction tomorrow. We want to include language in these written agreements as to when and how these commissions are going to be paid for those sorts of transactions. It's easier to contemplate, closings that happen at any point in time in the future, but there's going to be this interim period where I'm a person, I'm an agent, I've been acting in that capacity, and now I have a PREC, and then a deal closes, and there's this weird sort of interim period that should be contemplated in each of these agreements. So there's something, more to these written agreements than just this notional, oh, we have to put something in place. There's careful thought and consideration that needs to be given to each and every one, and we'd be happy to have the conversation with you on how to structure these agreements themselves. And then the only other requirement here that's really important to note is that there is a notification requirement to RICO. You have to notify them of the PREC and its address in the event that there are any changes moving forward. So why do we incorporate? What are the implications of it? And the big thing here, just jump to the next one for me, Anthony, to think about from a legal point of view is that second bullet point, the limited liability. So when people incorporate companies, you generally think of, okay, now I have the ability to create a separate legal entity, to clout the services in that separate legal entity, and to give myself protection, okay? Think of a widget manufacturer down the street. So they're creating their widgets, they're selling them out to the marketplace, something happens with the widget, and there's a warranty claim on it or whatever the case may be, then the company itself is going to be responsible for it. The shareholders, the officers, the directors, they have no liability for it. The shareholders generally aren't going to have any liability for the debts of that corporation. What's different in this situation for these PRECs is that limited liability nature falls away when it comes to your obligations to your regulator. So just because you have incorporated this PREC, it does not mean you are excluded from any purview of your regulator for following all of the regulatory requirements that come along with being either a brokerage or an agent, a broker or an agent, I should say. So don't think of this as being an opportunity to clout yourself in a corporate entity and exclude yourself from liability. That's not the purpose of these PRECs. The purpose is strictly for income referral, tax deferral opportunities. It's not to limit your own liability. And the other points here on this slide, really what I would just mention is that when you incorporate these companies, obviously there's upfront costs in setting them up. It's relatively inexpensive, and it's relatively inexpensive to maintain them year over year. But you do have, financial statements that would need to be prepared and separate tax filings that need to be prepared on behalf of the on behalf of the PREC itself. So the question people always ask now, because this is brand new, does it make sense for me to incorporate? That's an individual question. Just jump to that next one for me, Anthony. So for everybody on this call, and we're up to 24 people now, it's a case-by-case analysis, whether or not it's going to make sense for you to incorporate right now, okay? It's relatively cheap to set up these corporations. And it's a lot easier for everybody to implement them earlier on in their career when there are less assets or goodwill or intangibles that we need to roll into these corporations, or receivables that we need to roll into these corporations. But I would say don't rush into it just strictly because it's available right now. When should you incorporate? Again, that's something that you need to think about for yourself. You need to have the conversation with Anthony. You need to have the conversation with your advisors to figure out, does it make sense for you to do it? We're obviously doing these right now already because there's this big rush. October 1st came, people wanted to get these incorporated and take advantage of all the opportunities they involve. But I also have seen a number of people just doing it because their friends are doing it and their colleagues are doing it, and they haven't really thought about, why am I doing it for me? Why does it make sense for my family and for my business to set these things up? Because of the ongoing maintenance obligations, because of the additional filings, because of the change in the nature of your relationship with either your brokerage or with the brokerage with the agent. All of these things need to be thought about and carefully considered before actually setting up these companies. So don't rush to market, if you will, because everybody else is doing it. When you're setting up the corporation, though, if you get to that point, before doing it, you want to have a conversation with Anthony. You want to have a conversation with me about making sure that we set up the classes of shares in the right way for you. Some of the related services that we can provide you is we can set up holding companies. We can set up family trusts. We can roll over some of the assets and goodwill. Just jump to that next slide for me, Anthony. We can talk about your estate planning, okay? So we have, obviously when you set up these companies, there may be a need to take a look at your current family planning and revisit your wills, revisit your secondary wills, maybe set up a family trust to own the non-voting shares so that we can think about future generations taking advantage of it. These are all things that I would say have the conversation at the outset before setting up the PREC itself, so that you don't run into situations in the future where you either have to walk back structures or unwind them and reorganize structures that could have been better implemented at the outset. Can you set up your own PREC? 100%, absolutely. Lawyers, we're not the gatekeeper for any of this information. You can absolutely go online and fill out the forms and do this yourselves. The benefit in talking to Anthony, the benefit in talking to a lawyer like myself, is that we can give you that initial insight, that organizational insight, that tailored bespoke treatment that's going to get you the best setup possible, so that you aren't making, strictly through inadvertence, mistakes in your structure, mistakes in your setup that may cost you money in the long run to have to go back and to have to unwind. If you want to go ahead and set up your PREC, I encourage you to read as much information as you can online, but to think about a few things. Always make sure that you're naming your PREC in accordance with the regulations, okay? The regulations are somewhat ambiguous. Under the Income Tax Act, a professional corporation is a lawyer, a doctor, a dentist, a vet, a chiropractor. It is not a real estate agent, okay? So if you're naming your PREC, in my example, it would be the Michael McIsaac Professional Corporation. That creates confusion under the Income Tax Act. It also creates a confusion under the Ontario Business Corporations Act, because a professional corporation does not include a sales agent. I would recommend that you would name your company, in my situation, it would be the Michael McIsaac Personal Real Estate Corporation. It doesn't run afoul of any of these other ancillary statutes, and it's going to keep you on board. I want to make sure that I'd be the sole officer and director. I'd want to make sure that I set it up and I have multiple classes of shares for each of my family members to participate in this, but I would be the only voting shareholder. I'd want to make sure I knew how to file the right forms with the ministry. I want to make sure I knew how to maintain my books on an annual basis. And I would absolutely, 100% unequivocally, want to make sure that I had the right agreement in place between my PREC, myself, and my brokerage to make sure that all of those liability issues we talked about earlier on, and all of that compensation and remuneration issues that may arise as a result of interim closings that are taking place, are done properly and papered properly. You can do it yourself, for sure, 100%. But, you know, I can also sell my house myself if I wanted to, but I don't want to. I'd rather trust it to somebody who does this day in and day out and understands what needs to be done from a paperwork perspective. We're all intelligent people here, and we can all go online and generally figure this stuff out. But in these sorts of situations, I do think it's important to leave it to your trusted advisors, okay? So that's all I really have from a legal point of view. Anthony is the one that you're going to want to talk to, and I think he's probably going to go next. I remember the first time Anthony spoke about what he's going to share with you is the tax benefits and the tax deferral opportunities, and that really opened my eyes to the benefit of setting up these PRECs. Legally, you just, you know, it's like myself, I'm professionally incorporated, I put it on the shelf. It's the tax analysis and the tax considerations that really make this sort of planning exciting. So I'll flip it over to Anthony, and I encourage everyone to really pay attention to what he has to say, because it's pretty powerful stuff.
Yeah. Okay. Yep. Thanks, Michael. Appreciate that. And I'm not sure if everybody's familiar with the recent economic update that came out on Monday. Ministry of Finance, thankfully this time had no bad news per se in terms of tax increases or tax changes that would just cause even further complications to already overly complicated tax regime. There were actually some goodies in there too. So those of you on the call who are actually employees, not the self-employed and business owners, but employees, there's a little bit of a bone. One of the biggest questions out there was whether or not we'd be allowed to claim home office expenses under the pandemic. So apparently there's some goodie in there that they're going to give us about $400 for those of you working at home for a certain period of time during the year. If you qualify for that, you get a little bit of a write-off to claim some expenses. So there was some good news on that economic update, in addition to not having any more tax increases. Well welcomed. So just shifting gears then to a tax perspective, what's actually happening when these PRECs get set up? As Michael mentioned, technically there is a separate legal entity that's being established. Currently, as realtors are normally set up, at least initially, they tend to be self-employed individuals, report their income on their personal tax returns under sole proprietorship or partnership if there's some sort of joint arrangement, but typically it's a sole proprietorship. And by establishing a separate legal entity, being a corporation, there is actually a transfer of that existing business that needs to be dealt with from a legal and tax perspective. So I just wanted to mention that that is something that needs to happen, and there's certain forms and procedures that need to be followed so you don't run afoul of the rules. So if you are looking to set up a PREC or have one of those transfers done, you got to make sure that you do what you're supposed to do so you don't trip over and trigger any penalties or interest with the government. So just to illustrate that, I also wanted to potentially dispel any notions out there that we're talking about real estate commissions when we're talking about PRECs. So agents are earning commissions They have gross commissions and they deduct their expenses. They report that self-employed, set up the PREC, you have a corporation that then reports the exact same revenues and expenses. So nothing changes in terms of what you get to write off or claim as an expense, or how you're going to record or deal with your bookkeeping and accounting per se. Nothing changes except the entity who's recording the activity. So now instead of the individual self-employed, it's going to be on a separate legal entity's books and records. So a separate balance sheet, income statement, set of books needs to be maintained and recorded. But the activities you're actually recording don't change. So when we're talking about revenues and expenses, they're the same. There's no special deductions that a corporation gets as an expense that an individual who's self-employed running the exact same business wouldn't otherwise get. The main difference, of course, is when you're self-employed, you get to keep the profits. And after you've paid tax, the net profits after tax are yours personally. When a corporation's earning that money, now this is where the big change comes in. A corporation then pays tax at a different rate than an individual pays. So if a corporation has that money, pays a layer of tax, it's still a corporation's money after tax. Now, as you as an individual want that money, you have to decide how you're going to take it out and when you take it out. And that's where the tax planning can come in. And we can deal with things like looking to reduce your tax rate or defer your taxes down the road, depending on your personal needs, of course. So that's what we're talking about when we're looking at either a salary or a dividend when you're taking the money out. So that kind of leads me to the next area that I need to address, and I think we'd be a little remiss if we didn't address this, and that's that whole idea of tax integration. So this is really the foundation and cornerstone that a lot of our tax regime is built upon in Canada. And I need to at least look at it, and it kind of helps when we have the rates in front of us. So just going back to that slide now with tax rates, the idea here is that the amount of tax you pay overall when we're talking about tax integration doesn't change. So the amount of tax you pay, whether you earn that money directly as a self-employed individual or you earn it first through a corporation, then take it out as an individual, doesn't change. Theoretically, remember, we're always talking at theoretical rates because the tax integration regime is built upon this idea that everybody's at the top tax rate. Now we know, of course, not everybody is at the top tax rate, and that's where planning can come in, and your creativity can afford you a benefit if you can time things right, and again, depending on your needs and situation. But just to review from a theoretical standpoint, what the rules say, in Ontario, if you're a self-employed individual at the top tax rate, you're paying tax at 53.53%. If you instead earn that income through a corporation, and in this case, an Ontario PREC, you would be paying tax, and if we look on the far right-hand side, either at 12.2% or 26.5%. And the lower rate, of course, is on your first $500,000 if you have a small business deduction. That's where your benefit can really be taken advantage of if you don't need that money personally, because remember, that money's in the company. So a company will initially pay either 12.2 or 26.5% on that earnings. And if you were on to take that out as a dividend, well, that's where that second layer of tax is going to come in. So an individual would pay tax on a dividend after the corporation pays tax. So if you add the two taxes together, and while you can't sum it directly, we're going to look at a numerical example in a bit. The tax overall works out to the same theoretically. And the other middle column I kind of have there is, well, if a corporation earns income and then you take it all out as a salary, well, that salary to the company is a deduction. So there is no income to pay tax on in the company if you've taken it all out as a salary. Now you've T4'd yourself effectively from your company, you're going to pay all the tax. Well, if you're paying all the tax, then it's no different had you earned it directly anyway. So again, you're going to be paying 53.53% as an individual. So that's integration kind of in a nutshell. And those are the tax rates that I was referring to. Again, small business deduction, that is your earnings inside a corporation. up to $500,000, and this is where you have a rate of 12.2%. And again, this is where you can have a big advantage if you are, even if you're taking that money out. One of the biggest advantages you can have here is that you're working with theoretically 88-cent dollars or 74-cent dollars to finance and fund your business going forward. So even paying for your expenses now, you just have more money to pay for your expenses than you otherwise would have as an individual with only 46-cent dollars. So just jumping now to a numerical example of what I just talked about. Again, all at the highest rate here. This is our theoretical rate. If you want to see how that works, and I've got two columns talking about income earned in a corporation, either at the small business rate, so under 500,000, and then over 500,000. So just illustrating the two corporate tax rates, depending on what bucket you fall in. But ultimately, the first highlighted area shows that the difference in tax rates, you know, irrespective of where you are in a corporation, there's still an advantage of a deferral if you leave that money in the company, because initially you are paying a lower rate inside the company. As we move down the columns, and the second highlighted area, you'll see that after earning, an example, $100 in either column, you'll be left with an amount to be paid out as a dividend. So you can take that out in a future year or current year. And then there's the personal tax then you'd pay on that dividend amount that's left over in the company, which gives you a net cash to shareholder amount of $44.59 or $45.88, depending on the bucket you're in, for an overall total corporate and personal tax of 55.4 and 55.1 for the two columns. And if you were to compare that to the overall rate you would have otherwise paid of 53%, you can see that the integration math works pretty close. So there's a slight cost to actually flowing it through the company if you're at the small rate of 12.5%, or I'm sorry, at the higher rate of 26.5%, it'll cost you about almost 2 points, whereas it'll cost you about 0.6 at the small rate. Again, those are at the theoretical high rates. So now the real question comes up is, well, what if I'm not at the high rate and, you know, we're talking about normal rates and I'm not earning over $225,000 in Ontario personally, or I just don't have that much commissions to pay tax on, because again, it's revenue minus expenses that you're paying the taxes on. So if we were to look at a quick example of a real life situation here, where we're assuming an agent who has income, let's say, of $150,000, and we're going to compare that either in scenario A, where there is no corporation, and B, where we have a PREC, and the funds are then paid out to the individual as a dividend, and there's no cash retained in the company. So now, again, this is using real rates personally and in the corporation. And if we were to flow through the math, comparing just at the bottom line, you can see earning $150,000 in scenario A, after tax, you're left with $99,900. Earning that first $150 taxed in the company and then flowing that out as a dividend using the rates we just went over, you're actually left with about $3,200 extra, just actually flowing it through. So even at that modest level, let's say, from an income tax perspective only, again, there's more things to life than just tax, although I don't live in that world. There is still an advantage to be had when we're talking about real rates here. And again, this is at 150. So that's taking all the money out because you needed all the money to live. If you didn't even need that much money to live and you were to hold back some of the funds inside the company, again, just moving up on scenario B there, there's $131,000, $131,700 left in the company after that first layer of corporate tax. So with that in the kitty, you can then plan your remuneration strategy accordingly, depending on your needs. And you can stretch that over time. And one of the things we look to do is maybe spread that over tax years. So maybe you're not taking out 130 grand in one year. You might take out 65 grand year one, 65 grand year two, if that number works for you. And then that too would reduce your overall personal tax and actually leave you with a lot more than $3,200 at the end of 2 years. So I have a few more examples, and maybe during the Q&A, if it comes up and it's appropriate, we can go through those as well at just different income levels. But before I swing it over to Bruce, I just wanted to highlight the fact that and echo a little bit of what Michael was saying, that when you have a corporation, you have to address your estate planning needs, because at that point you are becoming a shareholder of a corporation. Again, it's a separate entity, so now you own shares of a corporation that's operating a business. So you need to deal with that from an estate and wills perspective, and we can help you with that. The other thing to mention is that as a shareholder, and this is one of the tax goodies we actually have in our Canadian tax landscape, is the whole idea of the capital gains exemption. So if you are a successful business operator and after time you have built up your business and there's enough value inside that corporation where you can actually sell it, for business owners on the call, you may already know this, but there is the potential to realize up to $880,000 of a capital gain tax-free, and that's per individual shareholder. So $880,000 tax-free that you can realize on either the outright sale of your business, or the shares of your corporation, or at death. So it can be claimed on your final tax return, because of course, when you die, there's a deemed disposition of all your assets when you die, and you pay tax on it. There are exceptions, of course, but generally speaking, that's at fair market value. And if a capital gains exemption is something that we can claim to shelter tax, we would always look to try and plan into obtaining the benefit from that. And of course, if you can imagine planning for a business where you can grow the value even beyond 880,000, it would make sense to get multiple shareholders involved in your corporation so that you can multiply that $880,000 across your family members, if that's something that would make sense for you. So just to cap off here, as you know, we operate, again, we understand small businesses. We don't operate in a vacuum. We get it. There's more to life than just tax. So we will work with you. We'll work with your complementary advisors, whether that's your bank, your investment brokers, or your lawyer, to optimize your position, not just ours. And sometimes that's just a quick or no answer on a financing proposal, let's say from a bank, and doesn't always involve a fancy tax plan. So owner-managed clients are our lifeblood, so we understand their needs. It's a holistic approach, and something BDO has been successful with in terms of just consulting on all our client needs. And this is something that we can even help you bring to market if it makes sense for your own client situations. In particular, in real estate, we've had a lot of success in the past, just helping advise on deals. And a lot of times, it's always nicer to get involved with the deal before the paperwork gets signed, and be able to consult in advance. And sometimes things like income tax or structuring in terms of ownership can be addressed and actually produce a better result, either from a tax perspective or an ownership and risk management perspective. And as Bruce is going to talk about, especially from a GST perspective. And we can help you help your clients, because I know you guys come across a lot more real estate deals than we do per se. And we can help you either review a deal or comment on a deal and work in some capacity to help you help your clients. And a lot of times that's in a commercial setting. Sometimes that's in a personal residential setting. Might be dealing with the family cottage, or looking to claim principal residence exemption, or even a lease arrangement. And you know, Michael can help you with a lease, or we can look to structure things from a tax perspective. That's something I just kind of want to throw out there so that you're aware of it. And we do work in that capacity, so that we can work with you in not just dealing with PRECs, but helping you with your current practice to either establish and further foster relationships that you have with existing clients, or even establish ones, because sometimes it's not just your client who can benefit, it's overall in that business team that might get you another client if you're dealing with the opposing party, maybe on a future deal. So with that, I'm going to pass it over to Bruce Gowdy.
Hi, everyone. Thank you, Anthony. And so Anthony has talked a lot about the income tax side, and one of the sleeping giants that, as you may well know, working in your field, that hits many people is, what do you do with the GST, HST on a lot of the transactions that you're dealing with? I'll talk about that briefly after this, but one of the main things that you need to look at when you're setting up the PREC is making sure that you register for GST in the same manner that you were hopefully registered for GST individually to start with. You'll collect GST on your revenues in the normal way. You'll claim your ITCs in the normal way. You want to make sure that the documentation is in place so that the purchases are in the names of the new corporation. Once you'll want to also make sure that you deregister the proprietorship to clean that up so you don't have to file blank returns going forward. And you'll end up having to file GST, HST returns. There are also some special provisions so that if you're making under a certain threshold, that you can actually use quick methods. So rather than having to track your ITCs, you can use a quick method to calculate your tax. You would collect it at 13%, but remit it at a much lower rate. And to do that, you would normally have to file an election at the time you register, or on or before or to make it effective at the beginning of a fiscal year. So those are some things to talk about. And then when you end up going forward by about year 2, depending on the amount of tax that you had to remit in the previous periods, you may end up having to make quarterly installments. And one of the questions that just came in is, what did it mean by clean up the proprietorship? So it was more so if you're operating individually and you're registered for GST, just more so closing down that GST number if you're no longer operating through it, because it's, but that may very well stay in place too, depending on the arrangements with the corporation. One other thing too to watch for is if there are assets being transferred into the new corporation. At issue is, do you need to charge tax on those assets? There are special provisions that allow for a business that, if you transfer an entire business into the new corporation, you could qualify for what we call a Section 167 election. But to do so, to qualify for that, you normally need to be transferring real property, or either a lease that you've got with somebody to be transferred. And so at issue is whether or not, depending on the value of the assets, whether or not it's worthwhile to take that risk, because the CRA has traditionally taken the position, unless you have leased property or owned the property and transferred into the corporation, they can't see how you're transferring a business. I recognize in today's world, where we're all working from home and elsewhere, that may not be the case, and especially in your industry, that may not be the case too. But I just wanted to let you know that that's something to make sure you look at, that if you're registered right now and transferring any assets of significance, you'll have to charge tax on them in the absence of any elections. That's it for this slide. Next slide, Anthony. And just a few other things that we deal with on a regular basis. And this is more so, not so much to do with the PREC, but things that we're seeing that are creating problems for many of our clients, and presumably for yours too. At issue is, how do you know what the tax status of these properties are when you're selling them? And some of the nuances that we run into are fairly challenging for our clients, because many times if you're the vendor, you are generally expected to provide a statement regarding the prior use of the property. And if you don't know what the legislation is in that regard, you don't want to provide the incorrect statement, because you could be held liable for the tax that perhaps you should have collected on the sale if it's an incorrect declaration. So one of the things that we watch for is where people sell residential properties immediately following substantial renovation. That's generally a taxable situation. At issue, what's a substantial renovation? It's more normally, or like you could have a big renovation, but is a substantial, actually the slide says completion, it should be substantial renovation. You've got to take things right down to the studs for it to be taxable. The other thing that's really common now is condos that are being used for Airbnbs. In those cases, if you've converted a condo into Airbnb use, the chances are it's likely taxable on the resale. Even though it's a used residential property, it's likely taxable, and your clients should be concerned with that. Cottages are endlessly creating challenges. Is it taxable or not, too, for GST, HST purposes? If it's ever been involved in short-term rentals, it's something that you want to look at because you want to look at what's the primary use of it really. Also, sales by individuals get complicated rather than, say, sales by corporations more so, especially when it comes down to vacant property or some property that's being held by individuals or that they've inherited. In those situations, you might want to make that property taxable if they're selling it to a business so that they can get back the input tax credits, because normally sales by individuals are, as you may well know, are exempt unless they're taxable or unless they've been leased out or been used primarily in a business. But there is an election available that has to be filed before you enter into a sale agreement with CRA, even if you're not registered, but you can actually make the property taxable if you want, because it allows the vendor to get back the input tax credits. Or it may allow the vendor to get back the input tax credits that they were not previously entitled to. So if they had bought it and then resold it. New condos, the residential rebates, that's one of the most common things that you're probably getting questions about, but it's something that we deal with very regularly. The residential rebates are a challenge because the general rule here is that to qualify for a residential rebate, so essentially 36% of your 5%, or the $24,000 Ontario rebate, the main thing that you've got to have is intent at the time that you entered into the purchase and sale agreement of what you're going to use that property for to get that new residential housing rebate. Alternatively, if you don't qualify there and you're planning to lease out the property, then you'd want to make sure that, or the client would want to make sure that they have that clearly documented. They can't assign any rebate back to the purchaser. And those are some challenges that we're running into. But CRA, that is one of the largest areas of assessments, is in the denial and assessments of these rebates. And that is the largest area that CRA has assessed when they provided their Center of Excellence for Real Estate, which is in Southwestern Ontario. And they've specifically focused on this area to try to generate revenue where people are, for example, flipping homes and not charging tax in the appropriate spot. But it's very easy to go astray, even though you have the best intentions. And if you have clients in that situation, we'd be more than pleased to help you out. And back to you, Anthony. Michael.
Okay, that was great, Bruce. All right, and I think we're approaching quarter two. And Brooke, I guess if you had nothing else to add, I was going to open it up to Q&A.
Yeah, we can go. I see there's one in the new group.
Yeah, and I addressed that earlier in the presentation, so I think we've got that.
Feel free to unlock if you want to ask questions, or you can chat as well.
Okay, there's a question on valuation, Anthony, on the value of the sale.
Yeah, sorry, my screen with the screen share is a little choppy here.
So here, I'll ask it, Anthony. You might be able to provide comments on it. It is, how do you value the sole proprietorship that's being transferred into a PREC? How is it valued?
Yeah, that's a great question. I'm not a valuator per se, but I work on the tax side, and we have a whole valuations practice that helps in this regard. And when you're dealing with proprietorship, I will dangerously speak to it, although don't quote me, because it is more of an art than a science. When you're valuing any business, albeit a proprietorship, you're looking for, aside from tangible asset worth, you're looking for goodwill. And when you're dealing in a real estate setting, that potentially could be an issue. It might not be. It depends on you, whether you've established your brand and your name. So there's going to be a lot of variables and factors that come into play that need to be considered. You know, how long you've been in business, what your track record's like, what your earnings have been like, and you know, how well established you are. And that those are some of the variables that do get considered when you're looking to transfer. And it's important to have a handle on that. And it is an issue that needs to be addressed, because when we look to, like I said off the top of my part, deal with that transferring to a corporation, you need to have some sort of idea, or a pretty good idea according to the CRA, about that value or what it might be or not be, and document that appropriately for your situation when you make that transfer, again, so you don't run afoul and trip over any rules that trigger any bad tax consequences when you're making that transfer legally.
Okay. There's also a question about commissions for deals done but not yet closed. And I'm thinking, would those contracts be transferred into or assigned to the PREC? Is that generally what would happen?
Yeah, I don't know, Mike, did you have a comment you wanted to add to that?
Yeah, so what we're talking about here are two situations. So the first one would be the payment of a commission from a transaction that closed before the incorporation of the PREC and before the entry of that agreement that we talked about between the PREC, the brokerage, and the sales agent. In that situation, okay, the commission would go to the agent itself, and the agent would then have the ability to either sell or assign that commission to the PREC, and we would have to create the paperwork there that gives them the flexibility and the option to do so, and that sale or assignment would have to occur at fair market value. And there's a few other things to think about there just to make sure that there are no adverse tax consequences. And the second situation would be, and I think it ties to I think Daniel's question here, is that it's the payment of a commission for a deal that closed after the incorporation of the PREC. So, and well, we use this as an example. Today is what, December 2nd. So we sign a deal for December 2nd, and the closing is on December 31st. So that'll be a great end of year, Happy New Year closing. Things are going to be running around, getting busy. Between now and then, let's say an agent incorporates the PREC. At that point in time, what you have to do is make sure that the agreement between the PREC, the agent, and the brokerage talks about those commissions on transactions that have been signed but not yet closed, and those commissions will be payable to the PREC. So there's just there's some subtle nuances to it, but in either situation, you can get the money into the PREC. The easiest situation, of course, would be for transactions that close after the PREC has been incorporated.
Yeah, so one of the questions, maybe Brooke, are the slides available to everyone? I'm not sure what the answer is on that.
If you send it to me, I can make it available.
Okay. Yeah, we'll check into that. Another question, if you assign the commission, is tax paid on the transfer? I'll take a crack at it from a sales tax perspective. I'm not sure if there's a value assigned. I'm not sure there's actually a specific fee for the assignment of the commission. It's more so the assignment of the contracts. So I'm not sure from a GST perspective there'd be anything payable on that, on the assignment.
Does that answer the question? I think he has a second piece there too. So it's a PREC agreement issue, not a tax CRA issue for deferring revenue. I don't know, it might be easier, Daniel, if you maybe unmute yourself and.
Yeah.
All right, sure. Thanks, guys. Thanks again for all the great information today. So, you know, I've incorporated my PREC, and I have some deals that haven't closed. That'll be closing probably end of the year or next year. So I was wondering, can I basically, to, you know, save all the money you guys are talking about, not paying personal tax, defer them to the PREC, or will I get in shit with CRA for doing that? Thanks.
So what does your agreement say between yourself, your brokerage, and your PREC? That should have language in there that contemplates for those transactions, the commissions that you would have otherwise earned are now payable to the PREC. If the agreement doesn't have that language in there, then you're going to want to talk to a lawyer, maybe me, maybe somebody else. It doesn't matter, but you're going to want to talk to a lawyer to amend the agreement so that it's very clear that that's how those commissions are to be paid and who they're to be paid to, so that if the CRA ever audits you, you'll be able to have that agreement to backstop the arrangement.
Thanks. I don't see anything. I'm looking. It's like a 3-page kind of cookie cutter agreement all the agents can get. I don't see anything about, you know, the delay of commission or anything.
Mm-hmm.
So, I mean, but CRA doesn't like when you defer revenue, right? Like most brokerages, if you ask them to start deferring your payments, they'll do it. It's probably not legit to do it that way.
But this isn't a deferral though. This is strictly just the compensation's going to get paid to your PREC as opposed to you.
Okay.
Yeah, and I think generally speaking, and from a tax perspective as well, when we're talking about earning amounts or having taxable income, it's the legal form of a deal or a transaction or an arrangement that's going to rule initially. So, I mean, if amounts are earned or paid, that determination is going to look to some written agreement that that's already been established, like Michael's suggesting. So for tax purposes, you know, we're going to look to what the contract says, and what the contract says is what is going to transpire for tax purposes. Does that answer your question too, Rosalind?
It sort of it answers half of it. What I was thinking about is if we have that in the brokerage agreement with the salespeople, and then CRA rules that it's you can't do that, what is the liability to the brokerage, or does it come back to the agent or the PREC, or how would that work?
I'm going to throw 2 cents in here and throw it to Michael, but I think CRA won't be able to call it undo an arm's length contract. So if it's in the deal, I think the tax is just going to be a byproduct of what your deal is. And as long as that's, call it legally sound, or that's properly done, I think that's kind of is what it is, right, Michael?
Yeah, the analysis that the CRA would likely make is they're going to try to take a look at the facts and circumstances to figure out, okay, we'll use Daniel as the example here. So Daniel worked on a number of deals, had them signed up at the end of December. They're closing at various stages in the beginning of 2021. Is he doing anything between December and the closing to help ensure that the closing actually takes place? So, you know, the lion's share of the work is done on the front end to get the deal signed up, but there's still things that, you know, Daniel would technically have to do in order to make sure the deal closes. So what the argument you make to the CRA is the agreement between the brokerage, the PREC, and Daniel is so that the brokerage would be paying the commissions otherwise earned by Daniel to the PREC. And the reason why the full entitlement would go to the PREC is because the commission itself was not earned until it's ultimately paid, but there was also things that the PREC, which is really Daniel, but Daniel on behalf of the PREC had to do in order to make sure that those transactions ultimately closed. The key thing here is you're not creating additional liability for the brokerage, but you need to make sure that the language in the written agreement between the brokerage, the PREC, and Daniel ultimately contemplates all of these things, right? And that's kind of the problem that, you know, we're seeing now is there are these cookie cutter agreements out there that don't contemplate the right limitations on liability and the right representations and warranties with respect to who's performing the services and how the services are ultimately being paid for.
Great, that's a great answer. Thank you.
Sorry, did you guys draft these cookie cutter agreements that thousands of agents are now getting their hands on through their brokerages?
No, I haven't drafted the agreement you're looking at.
There's only one clause really pertaining to payments. It's the first clause. Everything else seems to just be like, you know, the bulk of it seems to be about how the PREC will be structured. So it's the brokerage doesn't want to have issues with RICO or with CRA. So they're like most of the wording is just to protect the brokerage, it seems. And there's just one clause about payments. And it basically just says that subject to compliance with the Act, regulation, the agent agreement, and this amending agreement, the agent and the brokerage agree that the brokerage shall pay to the PREC all of the compensation that would otherwise be payable to the agent pursuant to the agent agreement after the date hereof.
Yeah, so in that situation, I mean, I don't have the agreement that you're looking at. I don't have your initial agreement with the brokerage itself, and I can't really comment on it. Where did you get the agreement? Who drafted the agreement? Is it a standard form that you pulled off the internet? I just don't know.
I got it from our administrator at the Sutton Group, but I appreciate you can't speak to that. So it sounds like I have to look at my original employment contract, which I don't have, and I have to speak to my broker of record to see, you know, if he's comfortable putting in some wording there that basically says that, you know, ongoing deals or commissions payable can be transferred between myself or the PREC without any fees or issues. Awesome. Thanks so much, gentlemen. Appreciate it.
Any other questions?
It's the last minute. If there's, you know, speak now. Listen, we're available. You see Anthony put up our contact information there. If you have any follow-up questions, feel free to shoot us an email. We're happy to have a conversation a little bit more generally if you'd like. But if you really want to dive into it, again, we'd be happy to you know, be engaged and take a look at not only your tax planning, but your legal structure and help you set up these entities so we do it right. I wouldn't worry too much about your specific contract, Daniel, but if you had any questions, give me a shout. I'm happy to have a conversation with you. Otherwise, we're up against the time, and thank you everyone for taking the time today. I hope you found this helpful and informative. I know, you know, that they're somewhat straightforward, but it's likely a little bit more complex than people realize. And I think the true value add here is talking to people like Bruce and Anthony and getting that holistic tax advice. And that's, I mean, as a lawyer, as a professional myself, when I incorporated, these were the individuals that, you know, people like them, not them specifically, but you know, these professionals were the people that I wanted to talk to make sure that I was looking through everything through the correct lens. So I would encourage everyone to reach out to either one of them. But that's all I have. Thank you very much.
Thank you.
Yeah, thank you. And the other thing I'll just add to that to wrap up, and thank you again, Brooke, for arranging this, is that if there is any other interest on particular offices that to want to have maybe something a little bit more quaint and you know, focused either for their agents or their group of agents, whether that's a couple of offices or several teaming up, if it makes sense. We're also happy to talk about that too. Just maybe reach out to us and or Brooke, and we could look to maybe set something like that up too.